Hello and welcome to the session. Accounting Principles LO3 Interpret Financial Statements. Have you ever wondered how to gauge a company's financial health? This video explores the world of financial ratios, a key tool in financial analysis. Discover how to calculate and interpret these ratios for informed economic decisions. Ratio analysis is essential for interpreting financial information. It involves comparing figures to produce a ratio, revealing strengths or weaknesses. This technique helps assess a company's performance, position, and prospects. Identifying trends and potential issues becomes easier. Regular analysis is crucial for planning future business growth. Ratio analysis simplifies complex figures, making them easy to understand. It allows comparisons across different sizes and currencies. This method is quick and straightforward for assessing business health. By using just a few key ratios, one can build a broad picture of a business. However, it's essential to be aware of its limitations. The quality of ratios depends on the quality of financial statements. Different methods can yield different results for certain ratios. Ratios highlight problems but don't suggest solutions. They are also based on historical data. Understanding these limitations is key to effective analysis. Profitability ratios include gross profit margin and net profit margin. Return on equity and returns on capital employed are also vital. These ratios measure a company's ability to generate profits. They provide insight into financial efficiency and success. Understanding them is crucial for evaluating business performance. Liquidity ratios assess a company's ability to meet short-term obligations. The current ratio and quick ratio are commonly used. Cash ratio and net working capital also provide insights. These ratios indicate financial stability and operational efficiency. They help determine the company's short-term financial health. Efficiency ratios include accounts receivable turnover and inventory turnover. Asset turnover and accounts payable turnover are also crucial. These ratios measure how well a company utilizes its assets. They provide insights into operational efficiency. Understanding them helps improve business processes. Leverage ratios assess a company's financial structure. Capital gearing and interest coverage are important measures. Debt-to-equity ratio and asset-to-equity ratio are also used. These ratios indicate the level of financial risk. Understanding them is crucial for evaluating financial stability. Gross profit margin is calculated by dividing gross profit by revenue. Net profit margin is net profit divided by revenue. Return on equity is net profit over shareholders' equity. Returns on capital employed is earnings before interest and tax over total capital employed. These formulas are fundamental for profitability analysis. Current ratio is calculated by dividing current assets by current liabilities. Quick ratio is current assets minus inventory over current liabilities. Cash ratio is cash plus marketable securities over current liabilities. Net working capital is current assets minus current liabilities. These formulas are essential for liquidity assessment. Accounts receivable turnover is net credit sales over average accounts receivable. Inventory turnover is cost of goods sold over average inventory. Accounts payable turnover is net credit purchases over average accounts payable. Asset turnover is net sales over average total assets. These formulas are key to measuring efficiency. Capital gearing is common stockholder equity over fixed cost-bearing funds. Interest coverage is earnings before interest and tax over interest expense. Debt-to-equity ratio is total debt over shareholder equity. Asset-to-equity ratio is total equity over total assets. Understanding these ratios helps assess financial leverage. Tesco plc's ratio analysis covers profitability, liquidity, efficiency, and leverage. Profitability ratios show gross profit margin and return on equity trends. Liquidity ratios reveal the company's short-term financial health. Efficiency ratios highlight operational performance. Leverage ratios assess financial risk and stability. Tesco's gross profit margin was 7.1% in 2020. It increased to 7.6% in 2022. Return on equity was 4.4% in 2021. It rose to 9.5% in 2022. These trends indicate improved profitability. Tesco's current ratio was 0.73 in 2020. It slightly decreased to 0.65 in 2021. Quick ratio followed a similar trend, ending at 0.59. Cash ratio decreased from 0.22 to 0.15. These figures reflect liquidity challenges. Correct. Tesco's accounts receivable turnover was 8.8 days in 2020. It decreased to 7.5 days in 2022. Inventory turnover improved from 16.5 to 15. Asset turnover saw a decline, indicating reduced asset utilization. These trends highlight efficiency changes. Tesco's capital gearing increased from 1.62 to 2.11. Debt-to-equity ratio decreased from 0.62 to 0.47. Interest coverage rose significantly, reaching 4.65. Asset-to-equity ratio increased to 0.32. These trends suggest improved leverage management. Tesco's financial ratios reveal a mixed performance. Profitability improved with higher margins and returns. Liquidity ratios indicate short-term challenges. Efficiency ratios show varied results, with some improvements. Leverage ratios suggest better financial risk management. Tesco's financial analysis highlights key strengths and weaknesses. Improved profitability and leverage management are positive signs. Liquidity and efficiency require attention for sustainable growth. Understanding these ratios aids in strategic decision-making. Regular analysis is vital for ongoing financial health. In conclusion, being able to interpret financial statements is essential for understanding an organization's financial health and performance. Interpreting statements such as the income statement, statement of financial position, and cash flow statement enables stakeholders to assess profitability, liquidity, efficiency, and financial stability. By analyzing trends, ratios, and key financial information, individuals can make informed decisions, identify potential risks, and evaluate business performance. This skill is fundamental to effective financial management and strategic planning. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 0748 436 1688.